All right, good morning. This is the new hours that we voted on yesterday, 7 a.m. on Wall Street, about 2.5 hours before the open of trading. It's time to get our global macro on and uncover the best fundamental opportunities across our global markets. Our AI driven data analysis of sentiment, inflation, employment, GDP, technical trends, open trade positioning, seasonality. Oh my God. Long term, medium term, short term, incredible amounts of data, and then put together in pretty little colors so that what we can get a very quick overview on our dashboard. We can do drill downs in particular assets. We can look at the institutional and retail market, but we can look at it two different ways. The capital stock, how much of a certain asset do institutional investors have in their vaults, but what was the change over the week over week? And that means that's the flow, the stock and the flow of institutional investing. We can look at what the central banks are projecting. We can look at multiple markets and uncover the intrinsic underlying trend, the trend that can't be seen. But if you're going to be a confident trader, you need to trade with the trend. Where most people make mistakes, both retail and institutional investors, their mistakes comes from trading when there is no trend. You're going to get mixed results. You just are. So you need to know when that is occurring and adjust accordingly. Look, it's a lousy $80 a month. This is your opportunity to change from being a retail trader focused on the next 20 minutes and becoming an institutional investor and start planning your trades in advance and letting your winners run. It's a way to reduce stress by organizing your thought process. See, you might want to look at buying these assets and selling those and ignore everything else. Okay. Instead of looking at everything on your charts, instead of looking at all your charts, is randomly going from chart to chart to chart to chart to chart. Instead, you're focused on what is actually happening, and your trading becomes logical and intelligent and informed. So you might dwindle, instead of looking at all your charts, you might only look at 6 or 7 charts today. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. We'll log in. I guess, do I have my phone? I don't have my phone. Where's my phone? I don't have my phone for some reason. Oh, there it is. We can take a look and see what the last alert was, since QuantBox watches itself for me. So the last update that I got from QuantBox was at 1:02 a.m. and that USD CAD went, it's a strong bear, strongly bearish. It went from a -9 to a -10. And the reason it dropped a point is the trend down got stronger. So it even tells you why the score changed. Oh, thank you, QuantBox. Okay. Yeah. So you can add that to your service for $1 a day. Yeah. And that's it. That's it. You can add it to your account for $1 a day when you're a member of QuantBox. Now, at 5:58 a.m., I got a market open report, and I got another one just before midnight. What time is that? I can't see the time on this one. It just says yesterday. Yeah, I got a report yesterday as well. So pre-London, that's the pre-London report of everything that's changed on QuantBox. And then I got another update not long ago, and it just updated my on the next thing that changed. So like changes on Euro CAD, changes on Euro Yen, changes on Aussie Swissy, changes on Bitcoin. Cool. That's included with the dollar a day, the alert, but the updates. Uh, it's just really cool. So now you don't have to scroll through QuantBox looking for what's changed since yesterday. You're informed. But it is a completely different AI. Like it costs money for me to build. It took me 6 months to build it, and it cost me every day to send it to you. So you should seriously consider having it because it is seriously cool. Sounds easy enough, right? Yeah, trust me, it took a lot of time and energy. They initially said it would take 6 weeks, and it took almost 6 months. I don't know if it was 6 months, 4 months, 3 months. It was a long time. Lots of meetings. But now, easy peasy for you. Okay. What is it? It's not even a dollar a day. What does it add up to? 89 cents? Yeah. Anyways. All right. All right. Look at this. What? Nice. Remember, I benefit when this falls at 2% day. Holy schnicker schnocker. That's like a week. That's like 3 weeks of price action in one afternoon. Nice. So me likey. Me likey. And that is part of my pension fund. So it's part of the funds that I run. And the interesting thing is, in the last 4 or 5 months that I've that I've owned the 20-year bonds, I've lost money. Yeah, I lost money um, in the value of the asset. And so when that falls, that means people are buying the assets. Remember, there's an inverse relationship. So I'm recovering the the asset's value. I'm recovering those losses. I'm getting closer to break even. That's why I'm like, prices are going up, yields are falling. But the other side of that is, while I'm holding it and losing the theoretical asset value. Like, think of it, if I own a house and I never sell it, and somebody's like, "Oh man, houses in this neighborhood are down 10%." Like, not mine, because you're not going to sell it. The price hasn't changed. It's not for sale, bro. Right? So I own these 20-year assets. I'm going to own them for 20 years. Oh, hey, bro, they're down 10%. No, they're not. So anyway, so the market value of these assets will change and recover, and it changes the numbers in my returns. But meanwhile, I'm earning 12%. So I like that cash. I like that income. And the cool thing is, I can take my 12% and then I can buy the stock market with it. I really could. I can do anything. It's cash. So I'm collecting rent, man. I'm collecting rent, but the value of my apartment building is starting to stabilize and go my way. So, anyways, this is a big deal, because if I'm happy, there's a boatload of people in the market. They're either happy as me or disappointed because they're on the other side of that trade. But if this starts moving again, people need to move their money. And most likely they're going to move it up the yield curve. They're going to go from the 2 to the 10 to maybe the 20 or 30. And that's why I'm hiding out in that yield curve. Okay. And it's also why I've added this T-bill analysis tab for you, and to analyze the T-bill and chill strategy, where you just hide out in the 2-year, which people have been doing now for a couple of years, sitting there. They don't want to be invested anywhere. They look at this as being in cash, zero risk, because it's guaranteed by the government, and they've been earning 5%, which is quite good. And in particular, once we hit the disinflation period, it was higher than our inflation. So you're like, okay, I'm profitable. I have no risk. I'm going to sit here for a few years. Remember that money is sitting there. And by the way, like I've been saying, like Goldman Sachs has offered me some money, Merrill Lynch, Morgan Stanley, and then I said there's shadow banking. I got an offer yesterday from American Express, the credit card company. They're like, give us some money in quote unquote a deposit. So now they're really truly acting like a bank. Put some cash at American Express and we will pay you 4.35%. So what are they doing? They're buying treasuries. They're buying this 2 year and they're acting like a bank, the shadow banking, right? But if this falls, that shadow banking will go away. So what are people going to do with the money parked in these shadow banks or parked in their money markets? What are they going to do with it? Well, if you answer that question now, you should buy those assets before they do. Okay. When the T bill and chill goes away, okay. And that's what this green line is. It's the yield on the 2 year dropping. Okay. We have below average inflation expectations, and money is moving out of the 2 year. And where is it going? They're buying my stuff, driving up the price of my stuff, and the value of their stuff is falling because they're dumping it. Now, is it crisis mode? No, dude, these yields, look at where we are. That's still incredibly high. That's still incredibly high. But things might be changing. This might be a peak. And we had a peak here at 5.0 several months ago. And then when that peak occurred, that's when I bought my 20 year. And if you want to know why about the 20 year, it has to do, you can Google this, the convexity of the yield curve, which means I analyze the sensitivity to interest rate changes, and the best opportunity when the 2 year was at 5% was at the 20 year, not the 10, not the 15, not the 30. So you can Google it, convexity of yield curve and duration. Cool. So anyways, so that's happening. As the markets change, people need to move their money around. If they expect the Fed to cut, then they should move their money out of the 2 year and move it somewhere. Where would they move it to? Well, they could move it to the S&P 500. And if everyone thinks the S&P is going to go up, okay, you don't need insurance. That's what VIX is. Okay. And you can see big changes month over month as it's becoming more of risk on. Now, our core numbers of CPI were not higher. The market really, they didn't need much. Not higher. Good. So anyway, so now we've had a low GDP, a low NFP, contracting ISM services and manufacturing, a not higher CPI. And if these things stay, if that becomes a trend, let's say over the next month or two, then by the time you get to September, it allows the Fed to cut. Yeah. So whatever, that's what's happening now. Don't worry, that'll change. That'll change. Don't worry about it. So anyways, so some things are starting to happen, and the response, the logical response to that would be some risk on. How long will this last? We don't know. I'm more interested in the monthly bias. Joseph says, yeah, well, how do I get the 12%? Now, I know you know, but it is worthy of the, of the discussion. So there's um, a fund that is sitting on a pile of 10, 15, 20, and 30-year bonds with an average duration of 20. Now you got this pile. It's an asset. So literally in a vault. It's not literally, it's a machine. But anyways, they own these assets. Okay. Remember, they own the assets. So they're sitting there and they're earning, let's say, on average about 5%. So it's a good question. So how the hell do you get 12? They write options against the asset. Okay. And so there's income on top of the income. And so, the fund and the fund managers are actively doing this all day, every day, writing option strategies against the asset. So, like a call option, for example. And from writing a call, so they're writing these assets, they collect cash. So you literally write a contract. I will sell you a 20-year T note at this price in the future, which might be 2% above the current price. If it goes up here, I guarantee you I will sell it. And for somebody else, that might be their stop loss. That might be their out. That might be their fallback position. But they're just like, because that, if the bond market goes up 2%, that might mean the stock market has dropped 5%, right? 10%. So people are like, what do I do if this collapses? So usually it's their out. Okay. They're like, I need to move to treasuries, or, and at the higher level, because you get higher income at the higher level typically. Usually the curve isn't inverted, right? So anyway, so our crew that is buying these assets for us, so this fund, think of it as hedge fund, right? We given them some money, they buy these assets on our behalf, they're writing these options. And let's say most of the time the market doesn't move 2%. That's a big move. Like most of the time that doesn't happen. But sold we've sold the contract to somebody else. We guarantee you we will give you our 20-year note at this price within this amount of time. And someone's like, oh my God, that'd be great. So if that happens, I'm going to like get these assets, right? And it's an option. So they put a down payment, if you will. They buy that contract from us. So we might say, let's say it's $10,000 worth of government treasuries that we guarantee to sell them, and they have to buy it from us for $500. And most of the time, what they're worried about doesn't happen. So eventually the contract expires, and we just keep the $500. And so then, now we collect interest from the government that's paying us 5%. Plus we got $500 on the 10,000, and you add them up and whatever, and you get your 12%. I know, smart, right? Yeah. I did some research yesterday on the fund, right? My fund, and the results are actually extraordinary. So in the last 6 months of constructing this fund with real money, and it's got real money in it, um, I it's produced a beta of 0.2. That's extraordinary. But a Sortino ratio, okay, 1 is normalish, 2 is good. Our Sortino ratio is 5.1. It's off the chart. When you run the analysis, there isn't even room on the chart for that kind of return. You're like, holy crap. Yeah. Yeah. Oh my God. I couldn't be happier. So, anyways, so we play little tricks like that, huh? Where we're earning 12% on T bills. Uh huh. Well, that's supermodel stuff. You don't have to be a genius. You just have to be a supermodel. All right. Big recovery in Bitcoin. Yeah, I owned a Bitcoin 2 days ago. uh, I don't want to talk about it. Anyways, so Bitcoin's way up there. Let's kill the Bitcoin. Platinum. I wanted to see copper. Oh, here, no big deal. There's something going on in the copper market right now, apparently. Yesterday there was a massive short on copper on the literally on the exchange, and then somebody started to squeeze that person. So like there was literally a battle going on between two hedge fund managers, or maybe multiple hedge fund managers against this guy. But anyways, copper popped because of the short squeeze. The guy that was short had to take massive losses and get out. And the thing popped because a whole bunch of, I guess, his competitors found out about it and were trading against him. And so, anyways, there's some drama going on there, like some real drama. And so copper's up, but also look, if everything else is up, then it makes sense. Look at platinum. Oh my God, huh? Silver's up, platinum is up. Where's my gold? I bought some gold yesterday and made some money. It's not here. Hmm. 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 I'm going to struggle to remember that. Mm, 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 mm. And then, okay, everything else is flat. Like, look at like Bitcoin is such an outlier. So you remember your mean, median, and mode? Do you- If I gave you a quiz right now on mean, medium, and mode, could you do it? I know you got through this in elementary school or maybe even high school. Um, But in one of those, you want to say if you included Bitcoin in the data set, it would kind of ruin it. Like it wouldn't matter. Like mean wouldn't be good for analysis because it would include this and it's such a skew. So you want to get rid of the mean. And that's why we do it this way, where you get rid of, crypto. And now you're looking for the median. Okay. And then mode is weird, isn't it? But so now you're looking at the median price, right? The center price. And then and what we're looking at, right? Yeah, maybe Rick. Then we need to have this updated. That's good. Good observation. Yeah, it would be over there, wouldn't it? I don't know if I can change that myself. Well, yeah, yesterday or the day before, Dan the man, I had mentioned this where um, the future growth outlook by like uh, who was it? World Trade Organization, WTO. Somebody came out with a less good projection for growth next year. And so that would be demand down, right? So with oil, you have to do supply side analysis and demand side. So the demand curve shifted. It wasn't a shift along the curve, it was a shift of the curve. Okay. And then typically, like the same thing, like if GDP in the United States falls, typically oil would fall with it too, because that would be demand side, right? Less demand if there's less growth. Okay. So like yesterday, you know, all these things pointing to the US economy slowing down, right? Lower GDP, lower NFP, lower ISM, lower CPI. Um, it has sort of that negative push down. All of that is just less demand. Well, I didn't say that, Dan the man. Um, simplify your trading. If you're a bull, you're now looking for bullish patterns. Okay. If I'm just looking at this chart, let me get my drawing tool. Okay. If I'm just looking at this chart and I'm a bull, I see some support. Hang on. Okay. Is support important if you're going to be a bull? Yes. Is it everything? No. So, what's the next thing you need if you're a bull? A reversal pattern. There we go. Finally got my drawing tool. All right. So, is there a reversal pattern? Not on the 4-hour chart, but you could be buying here. You could be buying here. Okay, this whole zone here is a buy zone. Okay, so these are opportunities for you if you're a bull. Okay, so you can buy at support, and this might have been a support level for you too. Okay, these are all buying opportunities. The more conservative of the buying opportunities is to wait for a higher high and then grab a higher low. So I'm a bull. I just haven't had an opportunity. So I wait. So it's not like, so don't trust this or trust that. Trust what? There's no trust. Nobody trusts anybody. This is a competition. Everyone's out to backstab you, damn the man. So you just got to wait your turn, wait for your opportunity. Okay. Stupid thing. Okay. There we go. Yeah. Yeah, so you're welcome to be a bull, but it doesn't exist on the 4-hour. Now, if you're only doing this, there were probably multiple opportunities that have failed. Well, that's what happens if you only look at a small time frame. Okay, right? You bought here, it went up, it came down, knocked you out of break even. And then you tried again, then it came down, knocked you at break even. Then no higher high, and then in lower low, and then it came pop back up, right? So you're like, this is frustrating. This is why you start on a higher time frame first. You realize, okay, right? The only thing that's occurred that's interesting on the 4-hour chart, the only thing interesting is well, let's do it in pink. It's just easier to see. Okay. Is that we have now double bottomed at the price level we expect bears to exit. So all we know is bears are exiting. That's our assumption. Step two is if we make a higher high, and I already have it drawn, either this level or this level. Okay. And I drew it days and days and days ago. If we get above that, then I have permission to buy dips. Okay. So it's just, I got it ambushed. I'm waiting. It just haven't occurred yet. So once you get sort of a higher high, higher low, that's when you drop into the 15 and you get in there. Okay. You could do it now and say, well, now that you have the double bottom, okay, so let's really zoom in here now. Let's go back to the 15. You could say now with the double bottom, you're interested in buying this dip at this price zone, right? Because that's what pivots are telling you. So you could start early, but there's additional risk with that, right? If you want to be in the first wave. But that's just a choice. That's not right or wrong. It's just a choice. Okay. Going back to here, weekly jobless claims. It won't be a big deal unless it comes in low. And then everybody will love it. We'll have another big up day today if it just happens to be, 220. Actually, no, we want it the other way around, right? No, we want it the other way around. If it's 230, yeah, then all good in the hood. Okay. COT, we don't need today. T-bill and chill, we already analyzed. So that's some risk on. Okay, central banking, we don't need update. Seasonality. How often do you look at this? Do you run this once a week, once a month? Okay. So like Dan the man might be saying, dude, oil is supposed to be going up. Well, wait for it. Wait for it. Wait for it. Pull the trigger, let it run all the way to Canada Day. Yep. Is that right, Hakeem? You do it every week? That's cool. This one is a monthly analysis, right? But you break it down into here. Yeah, with oil, I don't know what this is. It's just in the data. I don't know what it is. I don't really know to make much out of that. Um, but like one of the things I covered a lot earlier in the year was the stock market's general move. But do you guys remember we were analyzing like this looks like a key time in the year to buy once we're two standard deviations below the mean. And this is weekly, okay, weekly seasonality on the S&P 500. And it seems to me January, February, March, that sounds like 11 or 12 weeks, doesn't it? And so then we ended up getting a big drop in April. But we already really had known that we were entering an accumulation phase, right? Right. Do you guys remember my saying? Because I every once in a while people kind of challenge me on this. When I say buy in May and go away, people come to me on a regular basis. They're like, no, you got that wrong, Wayne. It's sell in May and go away. I'm like, yeah, when everyone is selling, that's when I like to buy. And so this is kind of interesting, isn't it? Where you had that big drop in April and a huge recovery in May. Yeah, I love buying, right? I love buying April, May, that kind of stuff. So, anyways, there's week 25 and week 39 are the next buying weeks, typically. And remember, don't look at it as, written in stone by God. No, it's typical. So all you have to say is, well, somewhere there's a window. Let's say in 3 weeks before or 3 weeks after, you should look for buying a dip. It's just being sort of ready, willing, and able to be a buyer somewhere around week 39 in a normal year. This year, right? I This dip here is going to last an extra month. I already covered this in January, so I'm not going to do it again. Okay. So typically, the third week of September is a buying period for me. Sometimes I start in August, but definitely by the third week of September, I'm a buyer of the stock market. What I said in January is it'll be the third week of November this year. Good to know. Isn't it nice to know 11 months in advance what your strategy is? Yeah, good to know. Well, that's a mix of having good data and some experience. Huh? The, these gray hairs on my head were not free, bro. Cool. You can break it down. Shows you, holy smokes, huh? It shows you just how unusual things are right now, where you're like, Aussie dollar skyrocketed. Okay. Euro dollar skyrocketed, all these things. And a lot of it was yesterday. Now, hardly anybody showed up to the day trading meeting yesterday. How come? One person let me know that CPI came out. We got our big move. We got our big vol. Everything went in the proper direction. And that person didn't trade. And I'm wondering if that's why nobody showed up. I'm telling you, there was two of us and there two people and me. Well, I wasn't saying names, but my point is, um, you got to trade those days, and a lot of people didn't even have the guts to show up. I think, and that scares me a little bit. Yeah. So yesterday, and this is all based on QuantBox. If you ask me, it's all based on QuantBox. I think yesterday I made 1,300 pips. Not 130, 1,300 from the CPI because and now you can see like all these dollar pairs took off. Well, that's the expected outcome. I mean, right, that kind of stuff. And I'm worried that people froze and didn't respond. And that's not your training was to respond. So anyway, so last night we went through I don't know like the 7 trades I made um and how I entered each one of them. And when you see them, you're like, "So snap," right? People are like, "But that's like textbook." Uh-huh. They're like, "Dude, that's just like straight out of the training course." Yeah. Yeah. Yeah, and Jim said, "Yeah, yeah, hunting season. Yeah, yeah." So, all of these things now, hopefully these things last, you know. that there's some lasting momentum behind the fundamental. Remember, the fundamentals of yesterday is that we're on the path for a Fed cut. And people are like, okay, the Fed's going to cut in the next 6 months, once or twice. I need to move my assets around to, to benefit from that change. And so if we stay on that path, then in theory, that trend will stay. So, like, that's why I added that T bill analysis. If this keeps falling, the stock market will keep going up and it will feel irrational and it'll probably be non seasonal because it's fundamental. It's not normal. Something abnormal is happening. And I keep saying, if there's, let's say, $1 trillion, but I think there's more than $1 trillion locked up in the money markets or shadow banks, which are just then taking the money and putting it in the money market. If that continues, then that money needs to go somewhere like the stock market. And if people are thinking the same way, then they're moving their money around. And that may keep the stock market going up, even if it's expensive and non seasonal and this, that, and the other thing. Right. But people are thinking 6 months in advance with the stock market. They're not thinking about today. Okay. Yeah. Well, it's Jim's still thinking one, but one in December. It's not about being right. It's understanding what everybody else is doing. So you might be correct, and there's ways to look at that. But right now, today, that's irrelevant. If people are moving their money, they're moving their money. Money has come out since the 29th of April. So it's been a couple of weeks. Money is coming out of the short end of the yield curve. And it is going to the long end of the yield curve. At some point, that'll get crowded out as yields drop below 4%. So then people will say, huh, well, now I don't want a 20-year or a 10-year at 3.9. So then they'll move to the stock market, right? You're talking about PPI? Yeah, it's the revision that caught everyone off guard, right? But you know what was cool about TRADARS is it said there's no scalp. So really, I put a little scalp on anyways, just for us to watch. But right off the bat, it didn't work. Well, actually, it didn't. It didn't. The way I played it didn't work. But do you guys remember? It said so between 70 and 80% chance that it'll fall no matter what happened. So in theory, now again, it's not the way I trade, but maybe I should play around with it a little more. I could have just had a short. Like if you just average it out, it's 75% chance it's going to drop. So I could have had like a 25 OCO and that would have worked tickety boo. I would have made 25 pips in 1 second. And then it eventually slowly collapsed and then reversed. But Tradars actually told us that as well, which was kind of interesting. The revision, yeah, that one's hard to play. It's hard to catch a revision, So because that's a dramatic revision, and the sensitivity to the revision made Tuesday unusual. Yeah, for sure, and that happens. But that's why we use stop losses. Sometimes you're wrong. There's no way you would have known a revision, so you take a loss. I lost 25 pips, but no, it has no impact. None. Cool. But then what we really care about is CPI, and not up was good enough for everybody, right? So cool. So we have some work being done on this data on the database. So hopefully there's no errors in the next few days, or let's say the next week. Maybe there'll be errors. So if you see errors, I apologize. But it's amazing. Like if you had 1,000 tables with 1,000 cells, and you change one cell, sometimes what we do is so complicated because all the thousand tables are interrelated. They work with each other. So you change one cell on one table, and then something over there breaks. You're like, whoa, what? Oh yeah, this is tied to that, which is tied to that, which is tied to that, which is tied to that, and therefore it failed because you changed this. So be careful. Sometimes things will break. But one of the things I'm working toward on the short term is making the user experience a little faster for you. You know, it doesn't. I don't know if it changes the value for you, but it'll make it easier to use. And then I think I'm going to move us towards this layout or something like it. I think, but it's not a high priority to me. Um, right? Not a high priority, but we may move that way. And I don't know how I feel about money supply being on here, but we have access to that data. But tracking M0 or M1 used to be what Forex traders did, because at the time of like Paul Volcker, there were no press conferences and there were no announcements of an interest rate change by the Fed. The Fed just did it. And not on any particular day, just whenever they decided. He would do congressional and Senate testimony, what, once or twice a year? But but there was no announcement. There was no set schedule where we all sit together and then three, two, one. The Federal Reserve announces a 0.25% interest rate hike, right? And then let's all talk about it, right? Back in Paul Volcker's day, there was none of that. It just happened. And back then, the most important thing was money supply. And so if you were a Forex trader back then, you watched money supply. I don't know if it's that important anymore. But anyways, maybe I want to simplify. I don't like how we have to squeeze this in here, but it's enough. It's enough, but because it's squeezed, it looks more dramatic. But there's your linear projections and stuff like that. So anyway, so you might suddenly see everything change. But it looks like they haven't begun the work. Like, for example, is GDP 3.4 in the United States right now? No. So already I noticed that. And they did an audit last week, and then I yelled at them the day before yesterday, and they're like, "Oh, we didn't we looked for errors, but we didn't do any math." I'm like, "Dude, I'm all about the math. You got to catch this." So they're going to fix that. Yeah, yeah, that makes sense. That makes sense. Yeah, thank you for that. Yeah, at one point they had space here for targets, but the targets weren't this. So I yelled at the developers, you can't throw out a linear projection that says 68.8 and then say here we're going to like 72.5. You're like, you can't. You're gonna throw everybody off. No one's gonna, well, like, well, which one is it? You know, So they're like, well, we can't do this. Then I'm like, well, then get rid of that. We don't need a target. Look, it's just right there. We'll figure it out. So, anyways, there's a boatload of stuff happening. I just want you to know that every single penny that you invest into QuantBox is being reinvested into new innovations all the time. Cool. So, are you using the back tester? I don't think you're using it. And I'm thinking about maybe I'll rename it somehow and then move it up here. This is a beautiful asset. It shows you here on May 2nd, QuantBox went from a bear to a bull and got very excited. You think it was that NFP? Of course. How beautiful is this, huh? And it's getting more and more confident as a bull. Now, right? So you can get right? You can get like very specific. When did it turn bullish? And this is what we're using for the alert service, the AI alert service, where it's watching this page most prominently, and then it has to go find out why did we go from a 10 to a 12. Well, you don't get that on this page, but you do if you're watching this up here. Okay. But see, even this is wrong. This doesn't match with that. So, there's some glitches going on. But we're working on it. And it's the problem is we're upgrading everything, which means we're downgrading everything. So bear bear with us. And I'll leave you for now. I will see you at 9 on YouTube. Yeah, well, it is historical. This is what QuantBox read on April 21st. It was a -8. Yeah. So it's a way to go back. But it's also a very interesting way to look at the market. Like if you were comparing this to your charts, it's going up, but QuantBox didn't have the macroeconomic data to support the upward move on euro dollar. It was happening, but it didn't understand why. And what we care about is why, not that it's happening. Who cares? The market could be wrong. The market could be stupid. They could be making mistakes. We don't care about what the herd is doing because the herd could be jumping off the cliff. But when the economic data started to change, which is different. Now, the herd in this case, the reason euro dollar was going up, where people were betting on the fact that GDP would be low, that ISM would be contracting, that non-farm payrolls would come in low. But those are the early birds, if you will. And as many times as they're right, they're just as many times wrong. So I don't want anyone, in particular me, I don't want to guess ever. And QuantBox, like this page, is so ridiculously powerful. Where you look at it like, I don't have permission to be a bull until we hit May 2nd. And QuantBox could prove why the rationale changed because we had a change in the economic numbers and dramatic. I mean, we had a GDP that dropped by 50% and then a low non-farm payrolls. Yes, that makes sense macroeconomically. It totally makes sense. And you can see where it's just like, doesn't make sense at all to totally make sense. Well, the economic data changed. And look how dramatic it went. It went from a -8 to a -1 to 0 to +6, +7, +8. Like we just started to get the data, and it didn't take 2 or 3 months for QuantBox to change. That's impressive. That's very, very impressive. And so since then, okay. Boop, 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 boop. Yeah. Very, very, very impressive. Yeah, very powerful. So I'll let you go. Peace on earth. May the pips be with you. May your profits be above average. I'll see you later today. And then if you're in my day trading group or swing trading group at investorbootcamp.com, I will see you for swing trading at 4 p.m. Have a great day.